Well, we had a lot of interesting numbers come out regarding housing data and home sales data in the last couple of days, and I'm trying to combine them all together and really see what because they're all pieces of the puzzle to see what kind of picture they paint for the housing market right now. This past year, I think, needless to say, the growth that we've seen cannot be sustained in the long run. But the question is, what do things look like in the short to medium term? Once we see an inevitable slowdown from the extreme pace of sales growth and price growth from last year, will that growth trail off, slowly or suddenly? So I guess the biggest headline is the Case-Shiller home price index is up 14.6% year over year. That is up even more than it was in March, which was 13.3%. Now, you would think that we're going to be pretty soon here, we would have to hit a peak in the year over year home price rises, because we're seeing a huge jump in part because of that brief drop off in March of 2020, just like with the price of a lot of goods and commodities in this economy. But considering the pace at which home prices have been growing, and at least in a lot of parts of the country, the way in which the market almost seems even more ridiculous now than it did a year ago, it makes me have to seriously entertain the possibility that home prices could continue to grow even at a year over year pace. And I mean increase their growth. They're going to grow regardless for the short to medium term. But what I mean to say is that even this 14.6% number, which is massive, I mean, if people thought that they could go out and buy a house and make 14.6% in a year, everybody would be doing that today. Hell, you'd be paying $100,000 over asking price, wouldn't you? Well, now that I say that, a lot of people are paying $100,000 over asking price. And frankly, in my area, people I've been talking to who are involved actively in real estate transactions right now, it seems like if you aren't paying in cash, you can't even compete in this market. And usually, if you were a cash buyer, you used to be able to bid lower than the people who were trying to finance their purchase. So, for example, if somebody wanted to purchase a $300,000 house and they made an offer at the asking price, in normal times, they made an offer of $300,000 and they had to finance that through the FHA or something like that. And if there was also an offer then from somebody who wanted to pay cash but was only offering $280, you might see a seller accept that offer of $280 from the cash buyer, just because there's less red tape and less headache in dealing with a cash offer. When you're dealing with a lender, there's just, you have inspections and, although a lot of cash buyers want inspections too, but these days, a lot of cash buyers are waiving them in order to increase their competitiveness in this market. But if you are financing your house, you don't have an option to waive inspections because the lender wants to make sure that house that they are financing is a good asset. They want to make sure that house is worth what you're paying for it, or else they're not going to give you that loan. And so I think that because of the competitiveness of this insane housing market, we are seeing mortgage applications plummet, even though home prices are rising. And I think a lot of people at this point are just giving up. There's no real reason for them to continue to apply for mortgages even if they qualify for the mortgage, they're not going to be able to place a winning bid for any of these houses. And so we're getting to the point where not only are ordinary people priced out of the market, not only are working class and lower middle class people priced out of the housing market, anyone who needs a loan at this point is getting priced out of the housing market in many cases. Only the uber wealthy, the top, the top 0.1% perhaps, who actually have enough money, who have enough cash sitting around that they can go pay cash for a house somewhere, really have a decent shot at buying a house these days. And even folks who are paying cash, if they don't offer a pretty penny, if they don't offer well over asking price, they're still not going to get the house. Like I said, in normal times, a buyer who who was only going to, really accept at their asking price would, generally accept a discount if somebody was paying cash. But those days are long gone. There is no cash discount these days, because everybody's paying cash. Anyone who really can compete. And so I'm not looking at this drop in mortgage applications as necessarily being bearish for housing. It could just be a sign, yet again, of how hot this market is. And that doesn't, just because the market's hot, doesn't mean it's going to go down tomorrow. I wish that were the case. I've been saying that for years, that I want housing to go down, that I think it's overpriced. And it is, historically speaking. If you look at, historically, where home price index like Case-Shiller, over the 20th century, home prices were flat. It's only been the period from 1998 to 2006, and then the period from 2012 to the present day, that we see this massive housing unaffordability crisis. And it, of course, has been created by the Federal Reserve and by Congress, making it so easy for people to get financing. But now we see mortgage apps declining and prices still go up, which really, it's shocking. But then again, I think that the low mortgage rates and the easy money mortgage policy is still what is the foundation for housing prices. That is why housing prices are where they are, even though those people right now can't compete in the housing market. Even though mortgage applications are down, the threat of all that money, of all those people who could apply for a mortgage, who could get a mortgage with under 3% interest, that is keeping housing prices high. Because the people who are paying cash for these houses know that if they weren't buying it, all of these people who need financing would come in and buy the house anyway. And so there is going to be a buyer for that house, maybe not at as high of a price as they are paying now, but there's going to be a buyer. And even if you didn't see prices rising as fast as they are now, they still would be rising because mortgage rates continue to decline. I've never seen mortgage rates below 3%. That to me sounds insane. That's below inflation. I mean, that's an amazing deal. If you could buy a house at a decent price for 3%, who the hell wouldn't do that? You'd be a lot better owning a house than you would having that money sitting in the bank. Hell, at that point, depending on what the price of the house is, of course, if you're paying, if you have a 3% mortgage on an incredibly overinflated, house, that's not such a great deal. But if you think about just in the abstract, paying a sub 3% mortgage rate on a house that is reasonably priced, that's an inflation hedge. But anyway, the point is, don't look at these declining mortgage applications and think that this is necessarily the housing market starting to turn a corner. I wish that were the case. But, I've been burned by too much false hope in recent years to not look at the most bullish case possible. And the fact of the matter is that the threat of those mortgage applications, the mortgages that aren't being made, the very threat of these sub 3% mortgages are enough to continue pushing housing prices higher. Now, again, do I think that they'll continue to rise at as fast as a pace as they did in the past year? I would say no, that's crazy. But then again, if you would have told me a year ago the rate at which housing prices were going to increase over the coming year, I would have also called that crazy. But remember, the effect of the Fed's monetary policy, in my opinion, has always been massive asset price inflation. And so as the Fed turns on the monetary spigots, you're going to see asset price inflation take off and move higher and higher. Now, when that turns into necessarily into comparatively high consumer price inflation, is dependent on the extent to which the Fed is monetizing government debt, which is being spent into the real economy. It's been a while since I've discussed this, but as long as the Fed isn't printing money and spending it on stimmy checks for ordinary people, assets are still, any asset, bonds, stocks, real estate, anything that is interest rate dependent, anything that the Fed is inflating, is still going to do better than consumer inflation. And I think the evidence is pretty clear. That's why the wealth gap keeps growing in America, because the people who own assets, their net worth is increasing at a rate faster than the rate of inflation, whereas you have people who don't own assets, ordinary working people, whose incomes are not rising at a rate as fast as the rate of inflation. And so for now, stocks, bonds, and real estate, as crazy as that sounds, are inflation hedges. Gold only becomes an inflation hedge when consumer price inflation really takes off. And, are we at the beginning of that? We have seen high inflation numbers coming out recently. But without more stimmy checks, that's not sustainable. I firmly believe that the inflation that we are seeing starting to show up, even in the government numbers, which of course are way understated, are a result of the stimulus. But if we don't get more stimulus, then those inflation numbers are going to drop. And the longer this goes on, the more I look at the bond market. Before, remember I said I was so disappointed in the bond market. I thought the bond market was going to save us. The bond market was supposed to react to inflation and raise interest rates, and thus collapse the whole house of cards. Perhaps that's too strong of language. But the bond market would have been doing the job that the Fed was supposed to, and would have reeled back in a lot of this monetary insanity, or rather not monetary insanity, at least price insanity. I don't think that the bond market has the power to deflate the dollar, but it does have the power to react to inflation of the dollar, and that, of course, would be seen in the inflation premium in the rate of interest. Interest rates should always be above the rate of inflation, and I think it's pretty clear that we have negative real interest rates as of right now. But if the bond market continues to not react, now again, this is assuming that there still is a bond market, and then the bond market is not entirely controlled by the monetary authorities. And this is something I go back and forth on. I've heard great arguments made back and forth between people who think that the Fed is totally in control and people who think that the Fed's control is a mere mirage. If you lean towards the side to think that the Fed's control over the market, or over the bond market, I should say, is a mirage, well, then you would look at bond yields, and you would look at, particularly the price of gold, and you would say, well, the market doesn't seem to be forecasting much future inflation, which to me says they don't expect there to be more stimmies. And the window for stimmies is closing. Sure, we still have another year until the election. We have until 2023 that the new Congress will be sworn in, but I think it is almost certain that at least that either the House or the Senate, one of the two, is going to go into Republican control firmly. And at that point, I think that after the inflation we've seen this year, the Republicans are probably going to be are going to strongly enough oppose any future stimmy checks in order to, to an extent that they would keep hyperinflation from happening. And frankly, I shouldn't even use the term hyperinflation, because that's too strong. Or we would get high 1970s inflation before we would ever get hyperinflation. But again, when money is being created, you have to look at where that money is going. It doesn't go evenly across the entire economy. Prices don't rise evenly. Wherever there's new money being created, that is where you're going to see a rise in prices. And so if that money creation is going into assets, then asset prices are going to go up. If that money creation is going into stimmy checks, which go into consumer goods, then consumer prices are going to go up. Oh, something I also completely forgot to talk about was reverse repo. Reverse repo spiked up to almost $1 trillion today. Although, from what I understand, and I've heard about this for a while, this has to do largely with quarter-end rebalancing that banks do, to where they want to, in the short term, put a bunch of U.S. Treasuries on their balance sheet to make themselves look more solvent than they actually are, and then as soon as they file their little quarter-end reports that have to be made public, then they take their money out of reverse repo and they go back to doing whatever they were doing with it. So we should see reverse repo pullback and have this short-term effect wash out, and then we'll see probably reverse repo continue its upward increase. It's just this nearly this 992 billion number, I'm fairly certain is going to go down rapidly in the next week. So I'll see where it is after that. But just as an alternate perspective, somebody who I do greatly respect, who I can tell is much more well-read than me on the minutia of the modern financial system, is Jeff Snyder of Making Sense Eurodollar University. Is a great podcast you guys should listen to. But I have to admit, a lot of the things he says are so counterintuitive to me that it takes me a long time to process them and to really try and internalize them and react to what he has to say. So I'll just offer his perspective, since I brought up reverse repo, as sort of a counter-argument to what I've been saying today. And that is that he interprets this spike in reverse repo that we've seen over the last weeks, months, whatever term you want to look at, as a evidence of scarcity of collateral in the banking system, which to him would signal a decline or a scarcity of liquidity, which would be deflationary, even in terms of assets. And so I don't want to get too deep in this because I do not understand his framework enough in order to properly interpret this. But from what I understand, this would be evidence of a headwind for asset price inflation. And so again, while I don't take that position because I don't fully understand it, and therefore I can't agree with something that I don't fully understand. It is nevertheless something that I will have to look into in the case that we see substantial asset price deflation in the coming months. Because again, the reverse repo thing, it's a big number, and it makes me think, gee, a lot of people say that this is really important, and I still do not quite understand why, other than, well, I should say, the way that I think about reverse repo, what it looks like to me is essentially quantitative tightening, in that bank reserves are being pulled out of the system and bonds are being put back into the system. It is a reversal of quantitative easing, which again, to me, in my opinion, although again, somebody like Snyder would disagree with this, to me, a reversal of QE should trigger asset price deflation. That's what I said was going to happen back in 2018 when the Fed was doing quantitative tightening and was raising interest rates, and lo and behold, that happened. But then again, you do still have the Fed doing $120 billion in QE every month. QE infinity is ongoing, and I don't know if this whole reverse repo situation is enough to counteract that. So the moral of the story is America has an incredibly financialized economy. All of these financialized assets, housing, bonds, stocks, even consumption to a certain extent, all move in one direction. And so when the tide starts to turn for any one of them, you would expect all of the others to move in a similar direction. And so I'm not yet ready to say that we're going to see a downturn in housing, even though I very much would like to see that. I do not see enough evidence for that for a downturn in assets in general, and so therefore I can't believe that people will just stop buying houses. Because I didn't mention this earlier, but I think a lot of the reason why you're seeing interest in cash buyers who are buying houses is because they're chasing yield. I mean, that's why you have companies like BlackRock getting into single-family homes. Right now, rental properties yield more than junk bonds. It's as simple as that. And so as long as junk bonds, are yielding that little, and, treasury bonds are yielding that little, as you move out the risk curve, that is going to, sustain demand for housing. If we were to see a pullback in other assets that was tied to something, more systemic and something that would have a medium to long-term effect, like, a change in the direction of interest rates, well, then I would start to entertain the possibility of a coming decline in housing prices. So, not a particularly great place to end off, but I guess it's as good of a place as any. So, with that said, I'll see you folks back here tomorrow.